We're talking today about an innovative approach to investing. Most investors want to earn a reasonable return with as little risk as possible in order to protect their hard-earned capital. It sounds easy, but the facts prove that it's not. For example, according to ASIC's MoneySmart website, a typical balanced fund holds about 70% in shares and property and the rest in cash or fixed interest. ASIC says that this portfolio should achieve a long-term return of 5.7% per annum before fees, taxes and other costs, and to expect a loss in 4 years out of 20, which is likely, as long-term US data confirms that on average, the share market falls around 35% every 3.5 years. So it's a bumpy ride for a fairly mediocre return. Is it possible to do better than this? And if so, how? After years of detailed research, we've developed a more scientific approach to investing, targeting better returns with less risk, irrespective of economic conditions and regardless of whether asset prices are predominantly going up or down. We start by viewing all investments as simply sources of risk and sources of return. And further, we understand that different investments will perform better or worse dependent on the prevailing economic conditions. To create the ideal investment portfolio, it's important to select the best investments available and then to combine them in the optimal way in order to produce the best possible return for the least amount of risk through the full range of economic conditions. What do we mean by economic conditions? Economic conditions are like the weather and broadly follow a recurring pattern known as the economic cycle. The economy moves through a period of growth, like spring, until it reaches a peak, where low unemployment puts pressure on wages and inflation, causing the economy to overheat, like summer, after which it starts cooling, like autumn, until it eventually hits a trough, where sales dry up, credit tightens, and businesses often close down due to bleak winter-like conditions, before the green shoots of recovery emerge and the cycle repeats. Whilst it can vary dramatically, the average time for a full economic cycle is around 5 years, according to the National Bureau of Economic Research. The key drivers of the economic cycle are growth and inflation, and as financial markets are forward-looking, asset prices are largely impacted by whether growth and inflation come in better or worse than expected. Unfortunately, the economic seasons are not as predictable as the weather, in both their order and duration. For example, you can have a long, pleasant spring, skip summer and autumn, and go straight into a freezing cold winter, as happened in the global financial crisis, in which a period of strong growth rapidly gave way to a financial market collapse. As it's impossible to consistently predict when the economic seasons will change due to numerous unforeseeable events, it's logical that the best option is to design an investment approach that works equally well in all seasons. Unfortunately, most investment portfolios don't do this. For example, balanced super funds are not very balanced at all. The investments they hold are heavily weighted towards spring and autumn, so they do well under these conditions, but they don't do as well in summer and they get decimated in winter, which is why super funds suffered significant losses during the global financial crisis. Of course, it's logical that if you hold 70% of your investments in growth assets, you'll suffer heavily when growth falls. This imbalance increases volatility, producing solid returns in good times and large losses in bad times, which equates to an average result overall and a considerable amount of risk. So what's the solution? The Rushton All Seasons Fund is diversified globally across a wide range of carefully selected and complementary investments and more than 1,000 individual positions to evenly allocate risk and return across each of the economic seasons, creating a truly balanced and intelligently diversified portfolio that targets consistently strong performance throughout the entire economic cycle with only moderate volatility. A genuine come-what-may approach that provides peace of mind so you can relax and enjoy life.